What a wicked reversal into the close on Friday. And I'm very intentionally calling it a reversal and not just a short squeeze. From being down over $5 to then rallying about 10 off of the lows, the data points were actually suggesting a bullish divergence nearly the entire time, which is somewhat frustrating as it's the exact opposite of Wednesday's analysis, but can we trust it is always the key question. My name's Matt, welcome to the Trade Brigade Weekend Show, and I want to show you those data points and build a game plan for the week ahead. As always, check out the links listed down below in the description, hit the thumbs up button, and subscribe, and stay tuned until the end of today's show. I've got 4 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So we'll kick things off on the SPY monthly time frame chart now that the month of May has, of course, officially closed out. What do we see in terms of candle structure and location? Certainly a solid green-bodied bar with very minimal upper wick and a strong close from the buyers near the highs of the overall range. In terms of location on the bar-to-bar count, we do see a higher low as well as a higher high. So buyers go 2 for 2 on the 90,000 foot view monthly. In terms of the trend, it remains in the upward direction. You can see that we have lows, higher lows, and potentially higher lows in the April pullback, and along the way highs, higher highs, and we're sitting on the highest high currently in the trend count. So the trend is up. There is no indication of a pullback looking imminent. However, if something were to emerge, we know that we could afford a monthly higher low without jeopardizing that trend. So let's take a look through the lens of a couple of Fibonacci retracement perspectives from the low of 2022 up to the most recent all-time high. Your 38.2 is loosely confluence with this previous pivot high, around 460. I really don't see that being in play for the coming month's worth of trade. Let's take a little bit more of a nuanced approach from here to here on the monthly time frame chart. So the pullback in the summer of almost a year ago now, up to the most recent all-time high, 38.2. If we extend off to the left, it's no longer perfect confluence with this newer higher high. However, it's loosely aligned with the previous all-time high, and that's going to be somewhere between 485 and 480. If we're getting consolidation up here, I would call that for what it is at face value and say, okay, this is bull flag consolidation. Let's take a look at the low of the April bar, and what you'll notice here is that we actually close, so the low and the close obviously, are underneath the March low. And is there any follow-through in the downward direction from the sellers in the May monthly bar? The answer is absolutely not. So a deeper pullback on the monthly doesn't really seem imminent here at this point in time. So as we were just classifying this as a potential bull flag, let's take a look through the lens of some measured moves to the upside and see what we're looking at. So if we do this down to the low of April as the pullback low, the measured move target on that particular look is somewhere around 609 in the upward direction. But hang on, it gets better than that. I've got a trick up my sleeve here. This is the major monthly bull flag from the sickness move to the downside back to the all-time high to the pullback low of 2022. What do we get? You get beautiful confluence at that 609. So bull flag from this perspective, bull flag from this perspective, 609 strikes me as a noteworthy number in the upward direction. Now, we're not talking about going here tomorrow, next week, next month, or even the month after that. But over time, as we're looking for potential targets in blue skies, 609 is something worth respecting. Something that's a little bit closer and possibly going to be in play sooner is coming in for the cup and handle extension without pulling back to the handle low. That's going to be around 570 as a possible measured move in the upward direction, perhaps over the next handful of months, 2, 3, 4 months. That's certainly much more within striking distance. So higher time frame look here is that bulls remain in control. Let's take it on down to the weekly time frame chart and see what else we can learn about the somewhat higher time frames here. In terms of candle structure, we are getting ourselves a hammer-esque style bar. It is a red-bodied bar, though, in nature, so we have to acknowledge that, yes, buyers stepped up near the lows and they were able to push prices back up in the upward direction, but only towards the upper third of the weekly range. We were unable to recapture the opening print for range expansion in the upward direction. Otherwise, we'd have a green-bodied hammer. Simply not the case. So structure is still bullish, I would argue, with the buyers responding off of these lows, but not as bullish as it could have potentially been. If we're thinking about location on the bar-to-bar count, we do have a lower high as well as a lower low, so the sellers do get that data point there. However, adding some more context here, what do we notice about this? Right, previous all-time high, the sellers pushed below, and the lower wick shows a failure of the sellers to close underneath that previous all-time high. So if we had stronger sellers, they should have closed below. It simply did not take place. So overall, I would still maintain a bullish stance here on the weekly time frame. If we bring out the anchored VWAPs on the weekly, what you'll notice is that this anchored VWAP directly acted as support. And there's some nuance here as well. If we bring out the Fibonacci's from the bottom of the move to the top of the move here, we're getting confluence with the 38.2. So once again, anything bearish really taking place here on the higher time frames? The answer to me is seemingly no. Let's also check in on the volume profile. If we just zoom back out on this chart, I think we can even knock this down to something like a yearly. That'll be fine here. Notice as we are taking a look at this as a high volume node, that's also very close to that anchored VWAP as well as the 38.2. The highest volume node on the weekly chart around this zone is still at 512.50, and that's still a major line in the sand here. But the fact that this is already acting as support, the fact that we closed back above the previous all-time high, leads me to believe that the continued look on the higher timeframes is totally bulls in control. Moving down to the SPY daily time frame chart, now let's firstly evaluate this week's expected move. If you're not familiar with this study, check out the video tutorial in the top right-hand corner. If we're contained by the upper bound, the number here is 533.64. That's actually going to be a new all-time high and therefore a higher high. If we're contained by the lower bound, the number's at 521.16, which is technically a higher low over the previous weekly low and the Friday pullback low, but it's technically suggesting the opportunity to move once again underneath 522.75, which, as we know, is a major daily line in the sand. So I'd be a little bit more neutral here out of this week's expected move. The trend, though, is certainly still in the upward direction. If we count from the lows, we have lows, higher lows, higher lows. We never had an hourly downtrend here or here. This is the first major hourly downtrend that we've seen. And technically speaking, we are getting the indications of a higher low near this major inflection point, right? Last week, we had the lower edge of the weekly expected move. We had the CPI gap close. We had the top of the 2-day balance range from back here. And look at where we closed on Friday, right? Friday certainly looks underneath all of those major inflection points. So don't get me wrong. On the hourly chart, we'll talk about what the sellers did there and whether or not it's overly damaging. But on the daily time frame chart, look at the close of Friday's session back above this key area, which we've already noted on the weekly time frame chart, previous all-time high. But on the daily time frame chart, I also think it's worth pointing out it's a recapture of the bearish engulfer low. If we look at the previous instance of the bearish engulfer, which really led to a nastier move to the downside, we never actually closed a daily bar back above once we had broken down, right? This is technically a gap up open near the highs of that red bar. It's not technically a daily close back above. And this is also happening, right? The breakdown really accelerates underneath the daily 50 SMA. Notice where this pullback goes. It's over the daily 50 SMA. And we've once again closed over some pretty major structure here, which would side more so with a bullish stance out of the daily time frame chart, as it's still technically in an overall uptrend. Now, I will acknowledge here that there is technically the threat for a possible lower high here up against the bottom end of this as overhead supply. That level is at 528.40. If we find rejections here and rotate back down underneath the previous all-time high, back down underneath that Thursday engulfer low from 2 weeks ago, yeah, I'll raise my hand and I'll say, okay, things on the daily chart are really not shaking out as we would ideally like, and we'll take it on down to the hourly to become, again, a little bit more nuanced. Like, what does this look like ultimately, and how should we be acting? So if we're thinking about this intraday, as we're trading intraday, I mean, it is worth acknowledging that, yes, on the hourly chart, there is the opportunity for the downtrend to persist. That's the threat of the lower high we just described here at 528.40. I mean, that's a very real possibility. However, let's also not ignore the fact that the close of Friday is over this inflection point. Now, it's not just the idea, as we move to the hourly at least, that it's the Thursday engulfer low, it's the previous all-time high. We've sort of sound like a broken record on that point. However, if we think about Thursday's lower high, last week's session, what did that represent? This was technically a gap fill reversal on Thursday's high of day around that zone. So the fact that this was sticking as a lower high and then we made lower lows into the Friday session, to me, raises the point that sellers in theory should have looked for a lower high here, or sellers should have at least been looking for an equal high to reject that Thursday low and the Thursday of this past week lower high gap fill reversal around 525. It simply did not take place, right? So if we're thinking about, do we have stronger sellers truly getting involved in the market? Yes. I mean, when we broke down underneath this 522.75, it was like all hell broke loose, and it was a very nasty move in the downward direction. So sellers, I'll give you some kudos on that move. Yes, we have the opportunity for a lower high threat here. However, if we get a thin structure retracement of the end of day spike from Friday into 525, which we've already described as a very key inflection point for a number of reasons, a whole myriad, right? If we get this as a higher low, I would certainly be more so aligned with the long side. One of the ideas and concepts we've been talking about as a primary long idea over the last week and a half or so is I would love to see the breakdown underneath the Thursday engulfer low to get a first wave of shorts really interested. We were looking for a lower high, and then ideally we were going to make another lower low, but hold up over 522.75. You guys can go back, you can watch the videos. I was looking for an inverted head and shoulders around this level on a gap fill reversal, previous all-time high test, and 522 to act as support. Now, of course, 522 was completely blown out on Friday, but the idea, the concept of the trade, understanding the participants is still very much so alive here. You brought in a wave of new money shorts. Shorts really got aggressive on that Friday morning session. And then what do we have now? Any higher low here keeps all of those shorts from Friday off sides, over 525. Thursday's engulfer low, previous all-time high, Thursday of last week's lower high, right? So 525 is instantly going to act as a key level in the early stages of this upcoming week. If we can hold that, if we can get an intraday 5-minute double bottom there, hourly double bottom, inverted head and shoulders, hourly hammer candle off of this level, I'd be very interested in trading this back up towards 528.40, where, as we know, we at least have to acknowledge the threat for a possible lower high, right, on the daily chart. So that's if we get a pullback first through some of this thin structural retracement, which we'll see on the market profile in just a moment. If the market totally continues to rally in the upward direction, any recovery over that threat from the daily chart at 528.40, I think our work is very, very straightforward, right? Any consolidation here is bullish, and then you have a very clear flat top breakout point. It's a poor high on the market profile. Over 530, I would be expecting all-time high as a test, and then possibly blue sky territories from there up towards the upper edge of this week's expected move. Sellers, if you're really going to have something going on, my daily line in the sand still has not changed. You need to show me price acceptance underneath 522.75. We don't move the goalposts. It is what it is. If this is a higher low, buyers are building more of an edge. If we pull back and do something that looks like this, fine. The breakout point is probably on the recapture of 525. So it's not a long here, it's a long here, right? The right side of the V, as we call it, right? If it's a lower high underneath that, then the breakdown is underneath 522.75 to target what? Of course, the Friday low of day. All right, so that's how I would navigate this. In here, you get a little bit wishy-washy, still with a bullish edge, and then underneath 522.75, that's where the bears really come back out to play, and I would say, okay, it's time to rock and roll. It's looking like we might get a flush of last week's low, and perhaps we go deeper from there. So that's what we have at face value from the ultimate candle analysis here. Let's bring in some Fibonacci's on the Friday rally. So again, holding up over 525 is over your 38.2 fib. That's, of course, bullish. If we bring out the intraday anchored VWAPs, let's take a look here. This is great confluence. Love to see it here. So from the low of the Friday move, midday there, the anchored VWAP as well as the anchored VWAP from what really kicked off the daily trend reversal in the first place, that's confluence at 525. If we can hold up over that, I'm very interested in the possible longs. If we flip below, as we've described, a little bit wishy-washy here. Shorts, yes, it's underneath 522.75. Let's take a look at the market internals. If you're not familiar with this dashboard, take a look at this tutorial in the top right-hand corner, because this is where it gets even more interesting, and you'll notice bullish divergences, right? As Friday's morning session was unfolding, let's specifically focus on Friday, right? I think for obvious reasons. The sell-off was very aggressive in the downward direction. What was your breath doing on Friday morning as the sell-off was intensifying? It was hardly negative. Hardly negative there. And obviously into the close, it gets substantial, very close to 300 million. So as this reversal is taking place off of the lows, it's exactly that. It's a stronger reversal at the exchange level. It's not just a short squeeze. Now, of course, the recapture of 52.62, which was our futures level for Friday, this definitely looks more like a short squeeze, and this is reflected in the volume inflows. You can see that huge pop into the close. If you look at the advanced decline line, a lot of the same commentary here. It was certainly moving in the downward direction, but it's well above the zero line as this Friday really intense sell-off was taking place in the morning. You can see the recovery into the afternoon, even closing in trend higher zone on the minor squeeze after we recaptured that key level. What about the cumulative tick? Did it ever get really negative on this large drawdown? No, it was actually positive. This is perhaps the most baffling of all indications that the market was moving lower so aggressively, and the tick itself was hardly printing negative indications. It was spending a lot of time over the zero line, and the cumulative build was positive. Obviously, into the close, it gets a little bit stronger on the reversal as well. Matt, you've omitted the one indication that you've been really talking highly about recently. What about that index score? I see it. It's really bearish, dude. Like, don't ignore that. Okay, we're not going to ignore it. The index score is meant as an intraday indication, and it's actually a weighted approach to the S&P 500. It really weighs heavily the things that matter. You could think about tech's impact on the S&P 500. You could think about the dollar. You could think about interest rates, right? And it measures that intraday. So, of course, it's very bearish as this breakdown is taking place because everything is under the opening print. Everything's down more than 0.5%. It's really aggressive. So, intraday, this actually worked quite well to keep us away from the long side early in the morning session. And then into the afternoon, I mean, I'll certainly raise my hand. It's not like we were long here looking to capture the squeeze into the close. Absolutely not. That would just be like a total pipe dream. I'm sure someone out there caught it long off of the exact low, and that's great for them. But the whole point being is that this weighs heavily what's happening, whereas the entire dashboard really takes into account breadth. So as we're talking about breadth actually improved as the Friday drawdown was taking place, and we'll see more examples of this as we move through today's episode. So as the breakdown was getting worse, breadth at the exchange level was improving. That's what this screen, that's what this dashboard really starts to prove here. Let's take a look at the market profile to finish up our S&P 500. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. This is where, again, we have to call it for what it is. We'll play the chart as it lies here. We've got to make a concession to the bear side, right? If you're looking at value, all of last week, value continuously migrated in the downward direction. Here is the Friday session. So sure, that end of day squeeze is really euphoric. It's like, oh, awesome, markets are rallying big time. But value was definitively lower on the Friday session, as was the point of control. What I find more so interesting as a nuanced approach here to the market profile is just understanding what's going on with the spike here. You have a spike in the M period of Thursday. You have a spike in the M period of Friday, of course. So spike rules will be in play early on the Monday session as we come into the bell. But if, like, here's the open on Friday, right? We opened over the spike. So in theory, all of the sellers from the end of day move on Thursday should have been underwater. This is typically a bullish open here. The fact that it broke down, and again, there's just a total lack of lower high intraday. There's just, again, we saw what happened on the hourly time frame, right? There's no attempt at a lower high here. There's no attempt at a lower high here. The market just totally rips to new highs, new two-day high as well. So that's interesting based on the Thursday spike. And as we also mentioned, it wouldn't be unreasonable for the market to retrace the spike from Friday. Now, where's the spike base? If you just do something that looks like this is very nuanced, right? This is a mechanical level. It's the base of the spike. It's also value area high from the Thursday session. On the S&P 500 cash ETF, we were basically talking about this level right here. This is loosely 52.77 to like 75, give or take. That's the equivalent of 525 on the SPY cash. If we can pull back, retrace some of the spike, find support in this zone, again, think about, let's just call it a 5-point zone for the sake of simplicity today, 52.80 to 52.75. If you find buyers here, it's a place where I would be pretty bullish and look for the rotation back in the upward direction. Notice the incredibly poor high. It's not really that poor high, but it is, certainly lacking material excess there. 2 TPOs flat across the top. That could be a first potential target on the pullback long back up into the upward direction. That, of course, is almost confluence if we just do something like this again with your high from that Friday session. So the idea here being, if there is a pullback, and this is an early morning trade, right? Something that does this becomes the target. Risk reward looking like this, and that would be a beautiful trade out of the ES futures from there, looking for the higher time frame follow through in the upward direction. If sellers are really going to make something happen out of the futures, show me the lower high underneath the level, trade back down into this low, and then we'll change tone when and if. Again, it's probably going to go back down to that 52.60 level, or it's going to boil back down to the analysis, that 52.60 level. If we're below that, okay, fine. Sellers will give you the upper hand there, and we'll see if we can finally get some follow through in the upward direction. But based on all of the data points we've covered so far today, I think it's worth keeping an open mind for a reversal, stronger, back in the upward direction. All right, let's do it all over again for the QQQ NASDAQ 100 on the monthly time frame chart. What do we see? Certainly structure and location incredibly similar to the S&P 500, so we'll keep it brief here. Structure and location is bullish, solid green body bar, higher low and higher high on the bar-to-bar count. We are sitting at the highest high in the trend count. The trend is up with lows higher lows and higher lows. We've got highs, and we're sitting on higher highs, of course. Let's take out the Fibonacci's just to check in and see if these are similar. Beautiful confluence. Again, this is not really in play for the coming month's worth of trade, but 381, if you are looking for a really aggressive pullback, there you have it. Let's take a look more nuanced from this approach, though. And this, to me, is really what's in force here. So this is bull flag consolidation, just like the S&P, looking for follow-through over the span of time. And, of course, much better with the confluence at the previous all-time high here. 415, 412, as we know, is that key inflection point. So higher time frames are bullish. We don't really want to look through the lens of the measured move of the bull flag yet because we still have not hit the measured move from the cup and handle. Here's your cup. Here is your handle pullback low. We're still not there, and that's around 475, we'll call it, just for the sake of round numbers. That, of course, is going to be an upside target if we continue here into blue sky territories. On the monthly chart, buyers are in control. Let's take a look at the weekly time frame chart. What do we see here? A little bit of a same but different indication in terms of the body of that weekly hammer here being a little bit larger than what we saw in the S&P 500. So sellers a little bit more meaningful over in the NASDAQ, and you'll also notice that the close of the bar is underneath the preceding bar's low and opening print there. So a little bit more structurally bearish things taking place, but please don't just ignore the lower wick. Of course, buyers did still step up, and they were able to close prices more so towards the midpoint of the weekly range here. If we're thinking about trend, it still remains in the upward direction, and the biggest takeaway is just continuing to understand that, hey, this is still acting as potential support. We did not break down underneath the highs of the 7-week balance. This primarily is one of the reasons why I would maintain a bullish stance here, even though the structure is a little bit more bearish than the S&P. Here we go with the Fibonacci 38.2. We'll come in with our anchored VWAPs as well on the NASDAQ side of things, and you can see that beautiful confluence here. Quick check-in on the volume profile, and we'll drop it immediately to the daily time frame chart. Here you have it. Once again, high volume node is acting as support here, so higher time frames, bulls on parade. Let's take it on down to a daily time frame chart. Flip back over to the NASDAQ here, and firstly evaluate this week's expected move. Here it is. If we're contained by the upper bound, the number is at 458.16. That is a lower high and not a new all-time high. A little bit more bearish than what we saw out of the S&P 500. And if we look at the lower edge of the expected move, the number is 443.27. It's an equal low to the Friday breakdown of last week. So expected move here is a bit more bearish on the NQ relative to our S&P 500. If we're thinking about the trend, it still remains in the upward direction with lows, higher lows, higher lows. And this certainly could act as a higher low. Remember, same reasoning as the S&P. We never had an hourly downtrend here or here. This certainly has been an hourly downtrend. One of the things I find interesting is the close on Friday being back up and over the previous all-time high. So, again, not ideal because we are still underneath this 453 level, but a first step certainly, and a strong bullish reaction off of these lows. All of this is still happening over a 50 SMA on the daily time frame chart, and we're above the origin of this larger breakdown on the daily time frame as well. So I wouldn't throw in the towel on the long side here out of the QQQ. Of course, the structure here is a bit more bullish. However, notice we were unable to capture the opening print on that Friday session. The S&P printed a green-bodied hammer on the daily time frame chart, unlike what we see here out of the NASDAQ. So walking forward, obviously this becomes key support as a must-hold area. You cannot afford for the the NASDAQ QQQ Cash ETF to be underneath 442. If we're under that level, then absolutely this is looking like a failed breakout of this as a 7-week balance range, right? And firstly, the target would be the bottom end, but then any sort of lower high starts to threaten what? This is a little bit sloppy, but some sort of head and shoulders, right? Left shoulder here, head, and right shoulder is emerging on any lower highs if this takes place underneath that previous all-time high. A little bit of a stretch right now, and once again, it's not top of mind yet, simply because we did close up and over that previous all-time high. So clearly, the bullish break is just the recapture of 453, and I would start looking for a move towards these previous all-time highs, these tests near the highs at 459.25. Let's drop it on down to a hourly time frame chart here and see what's going on out of the hourly. So a lot of the same indications as the S&P in regards to the trend, right? You still have a downtrend. You have lower highs, lows, lower lows. And you did not really recapture where this breakdown really accelerated from on the Friday session. The most notable part, as we talked about on the daily, is just that previous all-time high. So walking forward in the NASDAQ, I think you want to be very open-minded in this zone right here. This is actually a little bit more bearish than the S&P inside of this sort of no man's land, whereas the S&P can still find that higher low over 522.75, right? So on a relative basis, a little bit more of a threat here out of the QQQ. If there are rejections of this flat bottom at 453, I would think that you might actually become a seller there, looking for at least intraday risk reward that could pose a trade that looks something like this. And perhaps if you're like, nope, this is totally a fugazi, this is just not going to stick at all, it's end of month covering, it's end of month posturing, whatever you want to call it. If you're trying to balloon that trade into something larger, I mean, targeting that Friday low is not totally unreasonable considering that there's very thin structure in this area. So I can see more so the availability for a structural short on the NASDAQ compared to the S&P 500. Of course, the bullish idea, as we were just describing on the daily, comes from the break and recapture up and over that 453. If something like this were to take place, of course, your risk reward back in the upward direction looks something like this. One thing I do want you to continue to keep in the back of your memory is just that this poor high out of the QQQ, the NASDAQ side of the market, is right there at the all-time high. I mean, it doesn't, like, the market doesn't need to go there tomorrow. It doesn't need to go there at any particular point in time. But if we find ourselves trading at 459.25, this is not the proper end of the auction. And also remember, you have an overnight high that's acting as the all-time high right now. I would really expect a break if we're testing 459.25. So keep that as a back pocket idea if the recapture is strong and we move back up towards these highs into the midpoint of this upcoming week. Sellers, again, we talked about some shorts up here. If you're a little bit more neutral and skeptical of the market, if you're thinking, no, Matt, I think that the Qs are still going to do something like this and move in the upward direction, that's fine. You could take that idea. However, like, stronger sellers undoubtedly will come out into the market if we get something that looks like this, a lower high underneath the previous all-time high back inside of the 7-week balance range. And I think that's a reason to be somewhat concerned as we move into the future here. So this would be the best short opportunity in my view, just because we're underneath a key component of structure. You can still pull it off here, tight risk, right? However, just in terms of expectancy, I would tend to think that the probabilities of this trade unfolding are higher underneath the previous all-time high. Let's quickly throw on the intraday anchored view apps just so we can see what's going on there. Again, a lot of confluence will be here at the previous all-time high. You could just loosely call that 450, and then these two will be barreling down early on in the week at 453. If we bring out the Fibonacci retracements from the low of Friday up to the afternoon high, and maybe loosely, confluence there at the 38.2, reinforcing the previous all-time high, but not in love with that particular indication. Here we go with the NASDAQ internals. You'll notice more bearish, getting to the zero line, not negative, but certainly to the zero line, whereas the S&P was not even close. And then over here out of the tick, I mean, it did build negative into the morning and just hardly close positive into the afternoon here. So once again, if you're looking for a short, I would probably favor the NASDAQ side of things, and this really shouldn't be much of a surprise considering the S&P is more broad. The NASDAQ is certainly more concentrated. A lot of the things that were causing the pullback was the pain in Microsoft. That chart is horrendous now on the daily time frame. NVIDIA just closing that gap below, right? A lot of these names aggressively moving lower, of course, are the reason why your NASDAQ is more bearish in the first place. Let's take a look at the market profile. What you'll notice here is a lot of the same, right? The value area continues to drift in the downward direction here, being a bearish indication. Point of control is certainly lower, and we do not have an M period spike. So there's not really much of an indication to lean on there other than saying, okay, what do we have happen here at 18,550? If we can hold up over 18,550, great. Maybe that long does unfold. If you get the lower high underneath 18,550, if we just go back over to the platform, right, this really shouldn't be much of a shocker. Here's your low of the Thursday session. It's just a breakdown underneath the previous all-time high. So if you're looking for longs, if you're looking to be optimistic, the S&P is the place to be. If you're looking for shorts, if you're looking for this market to go to hell in a handbasket, the NASDAQ is the place to be. Let's do the full rundown one more time for the IWM Russell 2000 small caps on the monthly time frame chart to start. What do we see in terms of candle structure and location? Solid green-bodied bar, a little bit of an upper wick, certainly nothing to read into there. A little bit of a minor lower wick, nothing to read into there. Structure is bullish. Location is bullish with a higher low. However, notice the lower high. So we have a very classic inside bar on the IWM monthly. However, if we add in a little bit more context in terms of the location of this bar and where it closed, most importantly, notice that we're over the top of the monthly balance range from in here after April's close underneath. It would have been much more of a concern out of the monthly time frame chart if we rejected this area and then produced some sort of head and shoulders, something that looked like this, broke down through the monthly 50, and then we would have been targeting the bottom end of the range. Simply not the case with the May bar closing up and over that $200 mark, which is the top end of the balance range. We can take a look through the lens of a couple of Fibonacci retracements. If we do something like this from the sickness low to the all-time high, this is continuing to resolve the 38.2 in the upward direction. It's helpful, right? Again, higher lows, trends need to start from somewhere. If this is sort of a monthly cluster of higher lows, looking good. So far, so good. Let's take a look from here up at the all-time high to the low of the balance range. We're still sort of in no man's land. And if we could break out over the April and even March highs, that would be much more conducive for a continuation move back up towards the all-time highs. If something like that were to take place and we were to recapture the bottom end of this previous overhead supply, that would be a massive tailwind bullish for the S&P 500. So keeping that on watch here from the monthly perspective, if we can take out these highs, things are looking good. I would maintain more of that bullish edge across the broad market as a whole. Let's take a look at the weekly time frame chart and see what else is going on from this view. I would certainly argue that we've got ourselves a hammer-esque style bar, more similar to that of the S&P 500. What I find most interesting about this, and again, it's very similar to the S&P, is that we look underneath the previous week's low, yet close in the midpoint of the previous week's range. So that is a bullish indication here. And it doesn't really make me feel as though this is going to emerge as a head and shoulders. Now, of course, it's yet to be seen. We would have to make at least an equal high for that pattern to be off the table. It's still possible that this could act as a potential lower high here, but with the hammer, with the lack of sellers really driving price underneath the previous week's low, again, I would maintain a little bit more of an optimistic or bullish stance here out of the IWM just based on the lack of sell side pressure there. If we bring out the Fibonacci's from this view, right, we know that all of this is taking place over the 38.2. That, of course, is constructive here. Let's take a look at the IWM weekly anchored VWAPs here. We're above the entirety of the cluster, so once again, all good from that point of view. And we could even bring in the fib from here to here. I'm just curious. Yeah, look at this. The 38.2 on this view is also holding here over 202.75, 203 if you'd like to use a nice round number. This is looking good for the IWM on the weekly time frame charts here. Let's bring out the volume profile and see what else we can learn. Remember that there is a huge, let me bring this out to a 5-year chart just so we can see everything here. Right, this is a huge high volume node, and the more time we spend above that, the more likely I believe it is that we will rotate through the thin volume void up towards this area of high volume, which as we know is closer to 225. That would certainly be a break of the monthly highs we were just referring to for, once again, higher time frame participation as a tailwind in the upward direction for the S&P 500. Let's drop it on down to a daily time frame chart. Go back to the IWM. Here we have it. Weekly expected move. What do we see? Notice more volatility here this week, certainly. And we'll get to the VIX, of course, as an indication in a moment. Equal high is on the table, up around 209.64 if contained, and equal lows as well at 201.89, equal to the lows of the Tuesday. Excuse me, sorry, I'm getting my days mixed up here with the shortened holiday week. The Wednesday, big gap down out of the IWM, which was actually underneath the daily 50 SMA, an equal low back down there, again, 201.89. So expected move is neutral for that reason. This is really just developing as a little bit of a range here. However, I think there are some things worth talking about and worth pointing out, right? On that large gap down from the Tuesday session, there was no gap fill reversal. Like there was no closure of the gap overhead, and the close was actually underneath the Thursday large breakdown. It's not a bearish engulfer here in the small caps, but that's that bearish engulfer we were talking about in the NASDAQ and the S&P, right? So this close on Tuesday below, in my view, should have led to at least a test of the weekly inflection point, which as we've been talking about for a while now is 200. There's a gap fill reversal here on the daily time frame chart as well. But what happened into the end of this week? I mean, we gap back up over the 50 SMA, over the Wednesday high of day on Thursday based on the GDP print as well as jobless claims, right? This is always going to be more sensitive to fundamental news. It's a gap fill reversal, and we close where? Back over the highs, or at the high, or excuse me, lows, back at the lows of the two equal lows that broke down on the gap down from Wednesday. So all things considered, when I'm thinking about, do we have stronger sellers here? Do we not have stronger sellers here? Like, this should have yielded follow through in the downward direction if sellers were really going to be hammering small caps here. Like, it should have just fallen apart. The fundamental news about inflation really just remaining status quo and potentially getting ready to set up a smaller time frame rotation in the upward direction. That should have been scaring small caps into a larger move to the downside. It simply did not take place even on that Friday session with PCE, right? So when I look at this, when I think about what the participants are really showing us based on price action, right? As long as we're over 204, I would maintain a neutral stance being in the midpoint of this as a range, but probably more optimistic on the higher time frames for a sustained tailwind over time for something like your S&P. The only time where I would really say, okay, the sellers are coming back out to play is if we break underneath that 204. This is loosely, and it becomes a little bit more clear on the futures, but it's like a head and shoulders neckline. It's the 50 SMA. If we're underneath that 204 and we're testing the weekly, I think this is dangerous coming from a little bit of a nuanced lower high. If we're over 204 and in here on the daily, I just think it's neutral, and again, a small bullish tailwind for the S&P over time. The best bullish break and recapture would be over this level right here at 206.25, coming from all of these prior equal highs. If we could get over that and spend consolidation up here, I'd be thinking about the equal high breakout. And once again, remember that monthly time frame chart over this segment of highs here at 210.85. And I think you're off to the races through that thin volume node, low volume node from the volume profile we were just exploring. So major inflection points on the daily, keep it simple here, 204 and 206.25. Let's take it on down to the hourly chart. Let's see how we can navigate this. So this is really sloppy, right? Lack of follow through to the downside, upside, lack of follow, all over the place inside of this box. Once again, I would keep it simple. If we're pulling back and we're finding higher lows over 204, I would maintain a neutral to bullish stance. If we're over 206.25, I don't really think you would even want to include neutrality in that segment simply because none of the sell side pressure from here is sticking. This would be bullish, and once again, the rotation is up towards these highs. That's what we would look for out of the hourly chart. Keep it simple. Of course, what would that imply for the downside? Losing 204, and I think that this is the weekly test that we need to prepare for. A lower high here, price acceptance underneath, and you could say I would still be neutral here, and you could look for the breakdown through the equal lows at 202.50 for this test. That's fine. You could take that approach, but underneath 204, I would tend to have a little bit more of a bearish tone out of small caps here. Anything interesting from the intraday anchored view apps, this is probably not going to yield as good of a result here. I guess a little bit of confluence here at 204, a little bit of confluence at 206.25, reinforcing the levels. The Fibonacci's aren't even really worth slapping on there just because that Friday session was so muted inside of what was already a well-traveled and well-traded range. Let's quickly take a look at the internals for the Russell side of things. Volume inflows, yes, again, it's fine here over the zero line. Cumulative build is positive out of the tick here. So once again, maintaining that neutral to bullish stance and really requiring the sellers to prove it to us if something more detrimental is going to take place out of the Russell. Here is the market profile. You can see we're all over, but what I do want to point out is just the double distribution from the Thursday breakdown bar we've been using as sort of a reference, right? Where did we close? Obviously up and over. Where was the point of control on the Friday session? Over. Value was certainly up compared to the Thursday session. So this is different than the S&P and the NASDAQ, where value all last week was somewhat scattered, right? So here is the Tuesday session for the open of the week. There's Wednesday's lows. Here's Thursday. Here's Friday. So kind of all over the place, but primarily, again, if we're thinking about the double distribution from the Thursday breakdown reference bar, which is here, majority of the value, notice Tuesday, notice the Thursday and Friday session, is over that 2055. If you just wanted to use an equal level, it would just loosely be that, let's go back over here so I don't misquote you. Yeah, goodness. Brain power, here we go. We're looking at this one right here, 204. If we're over that, then we're over the lower distribution from the IWM small caps. And once again, I would want to maintain more of that neutral to optimistic stance, looking for upside. And this, of course, is a tailwind. I've said it a number of times now for the S&P 500. Let's continue to get granular here by evaluating the weekly performance of the S&P sectors. Leading the pack is the energy sector, up 1.65%. And as we know, energy is a lightweight sector. Utilities are just below, up 1.61% on the week. They're also a lightweight sector, but more importantly, they're a defensive sector. So as the market's trying to recover off of this pullback low, the sector posture is not really ideal, especially when paired with the fact that the semiconductors were the laggard on the week, down 2.91%. Then the XLK tech sector, in terms of direct S&P relation, right, is down 2.89%. That's the heaviest weight risk on sector for the market. Not really looking good posture-wise. However, let me caveat this by saying we always fall back on market structure. As retail traders, and this is my belief, you can disagree with me if you'd like, but my belief is that trade location is your edge and being able to change your mind is your edge. So, although posture is not great, the fact that we're over key structure, I would not just change my tone and say, okay, markets need to go to zero because, of course, the utility sector is outperforming. It looks like a risk-off signal. That's not how I would interpret this. It might dampen some of our confidence on the upside here, but it's not purely a bearish indication to say, okay, the trend needs to be down. It's certainly not at this point in time, right? So that's my take on the posture. Let's quickly flip through these structural charts. You can see that energy is certainly lower here. I'd be more concerned if it was making a new swing low. Anything in here is just sort of neutral, and as we know, it's sort of cooling off from an inflationary perspective. As long as this rally is put to a halt, that's going to continue to put downward pressure on inflation from an energy and energy services perspective. Utilities. This to me is a small concern. The higher low looks great. The equal highs flat across the top look great. And if there's a breakout over these highs at 70, let's call that 72.90. If we're over 72.90, it's definitely going to be upward pressure for the market, but it's a lightweight sector. My concern would emerge in terms of saying this probably shouldn't lead the S&Ps to new all-time highs. Again, by itself, it's not enough to just say short the S&P into the ground, but it's probably not a overly confident move at those all-time highs. You might want to reduce position size or just tighten up your stops, being mindful of any liquidation break from a heavier weight sector like the technology sector, which we'll get to in just a moment. Real estate, really lightweight, not much going on here. Could not find a higher low, then could not find a lower high underneath the weekly double top inflection point. Range compression, lightweight sector, not really worth focusing on. Here's the XLC. This is worth focusing on. It's a medium tier weight for our sectors, and it's definitely more risk on. I love the fact that it never took out the Thursday engulfer low, and we actually have a constructive breakout over these previous highs. So looking for this to be bullish pressure into the upcoming week. Here's the XLP consumer staples, getting a retest of the neckline from the inverted head and shoulders from back here. The higher low looks great structurally, but remember, this is a D for defensive sector, so I would sort of parrot the same comments from the XLU if this is leading the S&P towards those all-time highs. Next up, consumer discretionary is a larger, I would call it yellow flag here. We've got a little bit of a balance range overhead that has certainly broken down. I do like the fact that on the Friday session, we looked underneath the big red breakdown low and then closed over the highs of this entire phase of consolidation. So my first thought would be early in the week, upward pressure into the 50 SMA for a retest of the breakdown point is not unreasonable, but then finding a lower high here then turns into a yellow flag for your S&P 500. So really focusing on the XLY at 177.75. Let's move along to financials. This has retested the neckline of the double bottom in here, a little bit more aggressive than what we would have preferred to see, but I do like the recapture on the Friday session. So going forward, you just need to stay over 41.20. You can't really afford to get back down underneath. Otherwise, what did I just start to draw, right? Here you go with your head and shoulders. Even if you're not a pattern trader, if you're just a trend counter, that's fine. You would consider this a failed breakout over the previous highs back here, which keep in mind were all-time highs. So that's a failed breakout. This, of course, would emerge as a potential lower high on a reversal here. So from here to here, and now suddenly you're dealing with a downtrend, right? So you've got to stay over 41.20, consolidation here, and then possibly breakouts over 42 would be bullish for the S&P as a whole. Materials, really lightweight sector. It's really just in the middle third of the overall range. Not much to do here, so we're going to move along. Here's the SMH. Semiconductors look great. So, we'll give credit where credit is due. The XLF, the test of the neckline was not clean, but look at this. This is very clean. Now, you might be saying, what do you mean? The lower wick went underneath. Well, technically, take a look at this breakout point of the multi-day consolidation range here. It was directly to it. We closed Friday out as a hammer candle. Just from a very simple charting perspective, lows, higher lows, higher lows. The stairs keep stepping in the upward direction. If we're over 237, I don't really see how you could be a bear out of semiconductors. Any consolidation up here is constructive to digest the breakout over and into new all-time highs. So 237 is a top watch. I will change my tone if we break underneath and start to suggest a lower high. What does this start to emerge as? Potentially a head and shoulders. We're not all the way there yet. This is very speculative. Once again, I would really lean on the idea that this uptrend is very much so intact with a long lower wick supporting over the previous all-time high and the breakout from the balance range in here. Next up, XLK. I wish I could say as bullish things about the XLK being the heaviest weight component of the S&P, but I simply can't. It's not even really the same as the QQQ NASDAQ, noting that we're underneath the highs of the prior balance range, right? Notice where we closed. I mean, sure, there's this huge move to the downside, direct support off the 50 SMA, and we closed back inside of Thursday's range, but we're underneath 212. So, I can't really be as optimistic. If we were up here, then fantastic. Like, that would look awesome and great, right? But because we're underneath, I would be really neutral through here, open-minded to rejections. And if we fall underneath 209.50, if that pairs with the S&P breaking down underneath 525, underneath 522.75, then great. I will change my tone to being bearish with this as a threat. So the structural chart here is really what matters most. Watching the XLK this week early on at 212. Do we recapture that level? Do we get consolidation up here? Or if we're just down and drifting towards the midpoint of this range, that would really strike me as a concern. So the XLK needs to be on your radar as we move into this upcoming week. Let's move along to the XLI. Industrials, very similar to materials at this point, midpoint, middle third, if you will, of the overall range. Things get interesting here and here for range breaks. Let's take a look at the XLV healthcare sector and see what's going on through the lens of this. So we know that we broke down aggressively from this overhead range, and certainly thinking about with the strength on Friday, if we recover into that 144.75, what's the offering of a possible lower high? I mean, the aggression of the breakdown in here, the fact that it was not a slow and controlled pullback, does have me more concerned out of something like the XLV. You could argue that this is sort of in compression with the opportunity for a higher low, respecting the top end of the range in here. So, you get highs, lows, higher lows, lower high, and you sort of build out like, someone would probably call this a triangle from a classic pattern perspective, and that's fine. But overall, like as the third heaviest weight sector, the volatility that we're seeing out of healthcare is not really helping me gauge some sort of direction. I would tend to think that if we're underneath 144.75, this is more of a threat to the downside compared to some sort of bullish pressure to the upside off of a higher low. And my reasoning behind that is simply noting that we really did not get much acceptance inside of this as a range. I mean, we got a couple of days of consolidation, right? But the failed break over those highs did not make a move to the top. This breakdown, again, was not slow and controlled. It was volatile and violent. So I would tend to think more so about bearish pressure out of the XLV. That's possibly a threat into this upcoming week. Once again, 144.75 lower highs would be what you're looking out for. Let's take a look at the ratio grid. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. What do we see out of the heaviest weight risk-on sector? Pulling back aggressively, needs to find a higher low, basically needs to turn around on the Monday session and make a move back in the upward direction away from the 50 SMA. Based on what we just described out of the technical, the structural chart, I don't know that that's necessarily a high probability outcome into like the Monday, Tuesday. So keep an eye out for that. XLF is rebounding off of the lows in here. Not great. It's really more so sideways than anything else. So the risk on indications for the market are waning a little bit here. XLP is fading off. So risk off is not like totally full blown watch out, look out below. Utilities are still somewhat concerning, and we acknowledge that as well on their structural chart. So we'll watch out for those indications, but primarily it's all about the XLK higher low. Can we do it or can we not do it? Let's take a look at some specialized ratios. We have the XLK SHY. This is still looking risk on over the top of this prior range in here. That is a non-threat right now. Let's take a look at XLK XLU, rejection of the 50 SMA. So this divergence, basically what we would call out is that these highs, right? These highs, lower highs, and higher highs. So like this is not really sitting well with proper leadership out of the market. If you're a bear, you're probably leaning on this data point in particular. But again, it's not enough to really change my tone until structure actually breaks down as well. Here's apples to apples. Not great. It continues to just sort of drift sideways in this range. I'd really call this a neutral data point for the market. Maybe a little bit more bearish on the idea that this was a failed breakout back here. We failed to hold a higher low over the top end of the prior range, so possible consideration there. Let's take a look at the SMH XLV, and no surprises on this one with the large down days that we saw out of the XLV and semiconductors continuing to break to new highs. I mean, again, like clear opportunity, higher low. I don't think we have a, oh my goodness, bears are coming out of the woodwork, sending this thing to zero type of market on our hands. I think the recovery has been, it's impressive off of the lows, but it needs to prove it just a little bit more with some of these sectors actually flipping into a more meaningful, relationship within each other. Here's the dollar, and what I want to talk about out of the dollar is actually on a 5-minute time frame chart. As we know, when the dollar is moving lower, typically that is bullish pressure for the S&P market as it's easing financial conditions. And what you'll notice here is that the dollar was moving lower on Friday morning as the market was also aggressively moving lower. So in the intro, when I'm talking about how, the Friday session was a little bit confusing off of the morning, the dollar moving lower is technically bullish pressure. If we move on over to the TNX, and we've got to pop in the CGI here, look at what was going on here on the Friday morning as well. Moving lower. Rates were moving lower. The dollar was moving lower. So at its core, I wouldn't necessarily say in its entirety that the rally from Friday was totally short squeeze. It was driven by some pretty fundamental stuff happening earlier on in the session and the broadening of market breadth. Let's take a look at the inverted ZT, and this will sort of be the preface for our Fed tracker tool. Look at the possible breakdown here as well. If this is moving lower, what do we know that sort of means for the Fed, right? It's the implication that the market's pricing in, okay, maybe a cut is around the corner here, and if this does start to break underneath this shelf of support, then it probably just furthers the odds that the cut is going to move up in terms of time instead of out in terms of time. So let's take a look at the tracker tool and some fundamental data now. Not much of a shocker over here considering what we just saw out of the inverted ZT. We've completely removed Neil Kashkari's odds of a hike for the June timeframe, albeit fractions of a percent, of course, and the timeframe for the first rate cut has actually bumped up slightly. Remember, it was bobbling back and forth between November and September of this year. So that, of course, is slightly more optimistic for the market, and this is really on the heels of the data that we got last week. The GDP prints came in fine, 1.3 versus a 1.2 expectation. Initial jobless claims are well in line with expectations. The labor market is not breaking. We will be getting the full labor report this week. Then if we look down below at PCE, the headline number came in at a 0.2, beating the expectation of a 0.3 on the core month over month. If you have access to a Bloomberg terminal, what you would actually find is the number was 0.249 or 48, I believe it was. So fractions of a percent kept this from rounding up to a 0.3, which would have just been in line with expectations. If we take a look at the annualized read, this is the report itself, you can see that April's PCE was at 2.7%. So we're much closer to the Fed's target of 2% inflation annually. However, this is sort of stagnating. Notice that the road is sort of bumpy and we're sort of, again, stuck around this high twos mark. We haven't really made much meaningful progress in the downward direction here. And I think that the Fed will want to see that if they're going to even entertain the idea of rate cuts into the end of 2024. One of the big things that's taking place is primarily services. Notice this is, it's just sticky. We know that services inflation is sticky, but the degree at which it's sticking here, we haven't really seen a backing away from 4% in a meaningful way. We are not even close to 2% out of the services component of inflation itself, which is really just that major component, which is keeping things really elevated. If you look at the breakdown of the super core here, what I would want you to sort of note on this chart is the decrease in transportation services, which was sort of out of whack when we were looking at the CPI print earlier on in the month, but look at the meaningful increase out of financial services and insurance. So transportation services, I'm not sure how the breakdown is in regards to like auto insurance here, if that's included in transportation services for the PCE read, or if it's included here out of insurance out of purple. But regardless, purple did expand, and we know that insurance right now is really pressuring consumers. That's that sticky side of inflation, the services side of inflation that we just can't seem to shake. Never mind what's happening with the housing market, right, and owner's equivalent rents. We're talking about insurance being like the main thing right now, which is really driving and keeping inflation a little bit more persistent than maybe we would like from returning back down to 2%. Let's take a look at the upcoming weekly calendar. And as mentioned, we will be getting the labor report, but also some pretty important PMIs. This is on the manufacturing side of things here. JOLTS job openings on Tuesday at the 10 o'clock time frame. ADP non-farm preview on Wednesday at 8:15. Services PMIs come out on on that session as well, 9:45 and 10 o'clock respectively. Unemployment claims, the usual Thursday stuff. And then on Friday, we will have coffee and donuts up in the penthouse. It is the full labor market report. What's going on with the unemployment rate? Is the labor market breaking? How's the job gain looking in the market? And are we seeing a wage price spiral out of hourly earnings? There's not much going on the earnings side of things this upcoming week, but here is the calendar. Some interesting and honorable mentions. We have CrowdStrike, of course. HPE will be interesting again, sort of in that cloud compute space. Dollar Tree, if you're looking for the state of the consumer. Lulu's a decent trader on the options chain, possibly worth a watch there. DocuSign, long forgotten tech, not going to move the market. That's really it. I would say that your main watches are going to be Crowd and Hewlett Packard and Dollar Tree and Lululemon. You could put your sort of popcorn in the microwave and watch Neo. You could watch DocuSign for some laughs, but they're not going to move the needle for the overall broad market. Back on over to the graphs. What do we see out of risk appetite here? Starting with bonds in relationship to themselves. This move back over the 50 SMAs in the grand scheme of things does not have me feeling warm and fuzzy. However, the whole point of looking at the data points today is really noticing what was happening on the Friday session. As this was moving lower, this was certainly lower than the preceding session, as was this over here. This is bullish pressure for the market. So once again, in the intro, when I say something like, hey, the market's actually trying to make a more sustained move, there's actually a bullish divergence taking place, this is what I'm referring to. It's really, really nuanced, but it does support more of that move happening at the lows of the session and not just the short squeeze into the afternoon. So that's bonds in relationship to themselves. What about credit spreads? It's a lot of the same here. Again, I'm going to drop it on down to a 5-minute time frame chart. Notice the move in the downward direction. Notice the move in the downward direction. This is bullish for equities intraday, right? So that, of course, supporting once again, not just a short squeeze. What about the HYG junk bonds? This is already on an hourly time frame chart. Notice that we had a bullish divergence already in play. So here's the low, right? Obviously, we made a lower low. That's that Friday pullback, whereas the HYG was off to the races on that session. So once again, is this just a short squeeze? I can't call it that. It does appear as though we have stronger, more interested buyers getting involved on that pullback in the market. Let's move along to Bitcoin. Bitcoin just still stagnant inside of the upper bound of the range, so still looking fine out of the digital gold. Let's look at new highs versus lows. Once again, I'm going to go to a daily chart first, just so we can see on Thursday and Friday, moving back up over the zero line after failing it on the Wednesday session. So that, first of all, is bullish, but if we take a look intraday at something like a 5-minute chart, notice how this is strong out of the open. A lot of new highs being made compared to new lows at the exchange level. So once again, I just can't get on board with saying, okay, this market needs to go to zero if we're getting activity that looks like this as the market was selling off more aggressively. And this shouldn't come as a surprise, but I'll say it one more time. It's totally just because of Apple, Microsoft, as well as NVIDIA, the weightings in the S&P, that we saw that aggressive breakdown in the morning session. So, of course that could happen again, but the underlying structure of the market actually improved on that Thursday and Friday session. I really wanted to highlight that in today's episode. Here's the SPX A50R moving back to the 50% mark, away from the lows on Thursday as that Friday breakdown was taking place. So again, bullish divergence here. Let's move along to some RSP equal weight. Beautiful. Look at the Thursday session. It was actually higher, right? And then look at Friday. It didn't even move into, or hardly moved into, the 2-day range here. So again, broadening nature of the market rally is certainly the case as we're looking at these indications. QQQE is not quite as beautiful, right? You can still see we are underneath this area here. So this did technically break down. This is a bearish data point, but what did we mention at the end of the NASDAQ analysis? If you're looking for shorts, stay in the NASDAQ. If you're looking for longs, you probably want to favor the S&P 500 at this point in time. Let's move along to some volatility indications. And again, let's go to 5-minute charts. This is really going to help us, right? Volatility higher as the market was sort of breaking down early in the session. However, think about what was happening, right? Where, this, first of all, that was when we were doing the dance, but where are we in relationship to this previous area, right? This was technically lower and removed from the prior day's close as we were opening inside of range, right? So that, to me, another bullish indication here. Yes, it was creeping higher, but were we making a new 2-day high as the market was aggressively breaking down? No, absolutely not out of the VIX. Let's move along to the VVIX, and we'll keep these on dailies from here on out, moving back in the downward direction, a little bit more comfortable for the buyers. Remember, we were comparing this to the last bearish engulfer. So this right here is this right here, the large green bar, mild pullback and really accelerated over 103. Green bar, mild pullback. Did we accelerate? Did we even get close to 103? The answer is just no. So complacency effect can pick up back at 75, but in the grand scheme of things, as I'm looking through these additional data points outside of sector posture, I don't know necessarily that you would want to align yourself overly aggressive on the bear side at this point. VIX futures, just for a final check-in, bullish, bullish, and bullish, remaining underneath that 1275 as we discussed on the Wednesday video. All right, let's take a quick tour through the core list of companies. Apple is up first on the chopping block. Notice the consolidation inside of this range. Post-earnings, you have lows, higher low pullback, and this is healthy consolidation pressed into the equal highs here over 192.75, and we are looking for this as a possible upside target, 194.50. Beyond that, let's look left and find a target together. I'd be more interested in 198.25. You guys know the rules, round numbers only up here in the office. So this is healthy consolidation. Let's go down to the hourly. Let's see this a little bit more clearly, right? So intraday, yes, there's your bearish pressure being the sort of third heaviest weight component of the S&P these days. So bearish pressure, yes, but the recovery effort is really strong and the equal highs are very enticing. One of these sort of concepts we described in the Wednesday update video was that markets tend to move from balance to excess. If this is balance and we break out through the highs, we are trying to align with and capture some of the excess via a trend in the upward direction over 192.75. We will change our tone if this turns into a look above and fail. Only when there is a lower high here, then you can target the bottom end of the range. So if you're pessimistic, you want to see a failed breakout, but as of right now, I would align more so with longs over 191. This is your bullish breakout, 192.75, and the upper targets you can walk as we just described on the daily. Let's go back to dailies here on Microsoft because this was a how can we put it kindly, detrimental move to the broad market. Look at the magnitude of this breakdown. It even ensued on the Thursday session, just a clean break underneath the bottom of this previous balance, right? So this was looking constructive. We had an overhead range, and so Apple we're a little bit optimistic to the upside on because of its location, but it's the same concept here. We had compression of range, balance. When you exit the balance range, you are looking for range expansion, right? So on this breakdown of the level, I mean, you've already seen a lot of the downside trade play out, but what's the next step for this? It's twofold. It's either a lower high rejection here underneath the bottom end of the range at 419.25. Looking for shorts, lower highs give you risk reward that looks something like this. I mean, on the daily chart, you're probably at least trying to target the equal lows in here, the bottom end of the balance. I don't know whether or not we'll make it all the way there, and again, that's really why my preference is for shorter term trading anyhow, but let's move on down to the hourly time frame. You can see just like this straight shot back in the upward direction, there's really not much structure here, so wouldn't be unreasonable for this test. Notice we did the dance there on Thursday before the acceleration into the close. So 419.25 makes a lot of sense for that reason. If you get this though, what would the idea be? There's technically a gap in here. So 424 can act as a rejection. You're a little bit neutral through that range, but it's certainly a shorting opportunity keeping us underneath the bottom of this as overhead supply. So two short locations out of Microsoft, 419.25 and 424. If you want to press the bet, if you want to try to do something that looks like this for a long, I mean, be my guest, but it's sort of counter trend to what we're seeing now on the daily time frame chart. This has certainly drifted into failed breakout, moving back down, a little bit more neutral in the midpoint of the overall balance range here. Next up is GOOGL. What do we see out of the Goog? Daily hammer candle, just like every other daily hammer, but this one's a bit more impressive because it's off of the double bottom neckline on the daily chart. We know that we had the earnings gap and go, and so we have, or I guess it was a bit of a mild pullback here, but regardless, the point still stands, is that we're trying to navigate higher lows, and then this, could that be your next higher low? That's really what we're trying to figure out of Google. So if we're over the hammer high into the early stages of this week, I would be more optimistic looking for upside. So there's a thin structure retracement that takes place. This is probably a quick scalp to the upside, looking for risk reward that does something like this. 173.25, 175 is your target. If you're saying, nope, Matt, this guy's got it all wrong, he's just a fool dancing around on the charts, that's cool. I would probably be patient for at least a lower high retest of 175. I would not try to fight the thin structure retracement over the 173.25 breakout. We call that the Stevie Wonder sometimes if it happens in the blink of an eye off of the sort of morning session on Monday, like 9:31, as soon as the market opens. So thin structure retracement is available. 175 needs to be respected, but any higher lows above that, I mean, it's just totally daily continuation for the overall trend. Lows, higher lows, mild pullback, very controlled pullback. Nothing was out of hand here. It's not nearly as aggressive as Microsoft, right? So that to me would be the upside trade there. Next up, Nancy. What do we see out of Amazon? Certainly the opportunity for a weekly double top, sure. We're not underneath the neckline yet though. We did go for a beautiful and like perfect to the tick gap fill reversal on the Friday lows. Not that I had any interest in trading that. You guys know that this has been like the no man's land inside of this red box. So taking a higher time frame approach to the daily here, I would just be neutral and reserved in this range. Like we really haven't done anything out of Amazon for quite some time now. So I don't think that there's a long setup in here. I think even if it does move to the upside, you're looking for a lower high rejection underneath 180.25, and that's really coming from the hourly time frame chart where this breakdown sort of stemmed from. So I mean, like, the setup and the structure is there, but in terms of like confidence in the move, kind of low at this point out of Amazon, just kind of in that sideways range from the daily. So with that, we'll sort of move along to NVIDIA. One of the popular comments that was all over the internet, and it's cool to sort of interact with everybody on it, but here's the weekly NVIDIA bar, right? You've got yourself an inverted hammer, certainly shooting star, you could call it, whatever you want to call it. Is this going to yield similar results to this? Are we going to get sort of sideways activity and then maybe a more meaningful pullback? I can't say for sure, but it's at least an important data point worth acknowledging. Let's go back to a daily time frame chart, though, and see what's truly going on, because sure, that's the structure. It was a shortened 4-day week, and we closed basically unchanged, a little bit of a lower wick, a little bit of an upper wick. I think that this gap fill reversal is actually much more telling than the weekly shooting star. The fact that buyers were still willing to step up over the highs of the 2-bar range there at 1065, I don't really see a reason why. It's like all of a sudden this thing's going to turn into this big obvious short. I think buyers tried to pick it up. I think anybody who missed earnings and anybody who missed the gap and go is like, okay, NVIDIA, we're chomping at the bit. We're hoping to get a couple more big money trades in ahead of the 10-to-1 split before we have to size up like maniacs. I mean, that to me is like the total idea and mindset and framework that people have right now around NVIDIA, right? So as long as we're over 1065, I wouldn't be a bear. I mean, gap fill reversals in play. I suppose, technically speaking, you could get a lower high offering here. But at that, like, I would probably be patient. Like, I sound crazy. I just sound like I'm babbling at this point. I don't know that I would be an aggressive short here out of NVIDIA, anywhere over the earnings market maker expected move. We talked about this like how many weeks ago now, week and a half or whatever, at 1025. If we're over that level, I just don't know that there's an obvious short. And one of the things that I'll fall back on, I know I sound like a broken record here. We talked about it last time, but like, let the daily trend neutralize. If you're really intent on shorting this thing, if you want the big hurrah, if you want the big, hey, we're making a ton of money on the short side now, like, let the daily trend neutralize. Notice that we had double top sort of going sideways in a range, and then some shorts emerged after retests of this level right here, right? Let the same thing happen out of NVIDIA. Let this thing settle down, let some like more normal price activity come to it, and then I think we can have some more repeatable and, consistent trades. Like the big one trade that everybody thinks, okay, we're going to nail NVIDIA, it's going to go to zero. Those like hardly come, and if you do end up catching one, I promise you, that'll just totally skew your mindset. We're getting a little bit too psychological now or philosophical about the market, but it'll skew your mindset, and all of a sudden you'll be thinking about like, okay, I'm going to nail it every single time, and I promise you, you likely won't. Anyways, let's go back to an hourly time frame chart here. We're moving along to AMD. We're letting NVIDIA be. We know our levels. We know 1025 and 1065. AMD, sideways in the range. Apple, same concept, right? Balance turns to excess at some point. You've had lots of fake outs, one here and one here and one here. So most recent fake out was to the downside. Let's see if we can get going in the upward direction, and whether or not these shorts are going to squeeze, or if it's just going to continue sideways in the range. Not really interested. I think the better weekly or like daily trade at this point is over 172 into 182.75. I mean, you've got a 10-point range for clearance there versus trying to scrape up pennies, kind of like, doing whatever inside of this balance range here. If it is going to offer a short, it's got to be the lower high underneath 162.75 based on the failure from that Friday session. So it's really got to turn around if something more meaningful is going to happen. Next up is Metaverse. We've been waiting a while for this trade, and let me just show you on a 5-minute time frame chart because it was just so beautiful, right? Here it is on the 5. Look at the break, look at the lower high. It offered you the perfect candle, right? For those of you who know entry bars and signal bars and all that. I mean, just beautiful inverted hammer on the retest of the 463. If we back it off to a daily time frame chart, how long were we waiting for this balance range to flush? So I truly hope you caught a piece of that move of Meta on the Friday session there. But now we do have a hammer that has closed back in the range. This is a failed breakdown, other than if you caught a quick piece of the move on the scalp. So to the upside, top end of the range is the target. Let's go back down to the hourly so we can talk about that. Let's go hourly here. And of course, the idea is over 169, clear that shelf, and the top of the range is the target. 474.75, not 174, and 476 as the top end after a look below and fail. Target's always the top, right? So that's the primary outlook here. Consolidation there keeps the trade alive. This is your entry. If we slip it back to the downside, looking for new opportunities to short through some of this retracement, looking for a daily higher low, 443.25. Next up, Tesla, just like Apple, just like AMD, consolidation, balance, looking for exit excess at some point, but we really haven't done anything constructive out of Tesla. Folks, this is still an hourly time frame chart. So, I mean, it's got to be over 180. Even over 180 becomes a little bit dangerous based on a couple of the fake outs from the Thursday session. Notice this level becomes more interesting. Over 185, now you've got thin structure to retrace, whereas in here you've got fake out 1, sort of gap up, fake out 2. Pullback didn't really yield much, right? So it might be a little bit choppy still over 180, but the idea would be, okay, this is a good first step. Then over 185.75 trades to 198.85 as an upside. Still very interested in the bottom end of the range if it wants to get there, but again, noting sort of these end of day rallies into the Friday session, we'll just stay reserved, right? So 173.50, if it flushes, great. There's something there to 167, but one step at a time. One step at a time in the midpoint of the range. Not much going on with Tesla. Next up, Netflix doing a little bit of, I would say, counter trend movement compared to what it has done recently. I mean, this thing's been a nonstop freight train in the upward direction, and we did get a bit of a stronger sweep here. So I'd be thinking about the daily reversal based on this as an hourly head and shoulder. So can we find that right shoulder? 650.75 would be what we're looking for a bit of a deeper pullback, probably something like a weekly to get us into this. And then here, I would say, okay, weekly higher low there. So just trying to traverse the time frames and navigate those things without actually flipping the charts, right? So hourly head and shoulders is here. This sort of sets up the deeper daily pullback, which offers a weekly higher low coming from this low, looking for a higher low there, and then continuation over time in the upward direction. So that's sort of like some larger vision for Netflix, but at first glance, I would just sort of be a little bit more reserved and say, okay, first test, show me the short here. Maybe there's tight risk reward to the downside early on in the week. If there's nothing there, if we just break right back up through this level, okay, you know the MO from Netflix. What's this thing going to do? It's likely bulls on parade and a nonstop freight train for higher. Next up, JP Morgan. Let's take a look over here. This did resolve its balance range in the upward direction. I was unable to capture this one, thankfully for Meta, but anyways, this did, it's the exact concept that we're looking for out of Apple. Balance range break. This one is in the upward direction. Let's take it on down to the 5. I actually wasn't even looking to see if we got something there. Not as clean around the top end of the range there, but certainly an offerable pullback here. Regardless, I think that JP Morgan, let's take it to a daily time frame chart just to understand this, right? We've got lows, higher lows, higher lows. I think the equal high has to be the target here. So any consolidation now wants to remain over $200.75. Equal high is the target. Blue sky territories beyond that. Let's just get directly into these trade ideas. IBM is the first one on the watch list. We've got IBM Watson. What do we see? We've got ourselves a range here. Sort of a lackluster move into the earnings gap, but I think that this is setting up again off of the daily 200 SMA. I certainly want to acknowledge that, yes, this could be considered an H pattern, but noting the relative strength slightly on the Thursday session, a little indecisive doji instead of a red day like the NASDAQ, if we can get some upside here over the Friday high back inside of this balance range, I would think that the top end could be in play. It would be another support point off of the daily 200 SMA, which is still upward sloping at this point in time. So the interesting thing for IBM is a long here. This is a 5. That's a little bit too granular. Let's go hourly. The interesting idea is this is a double bottom on the hourly. Can we hold up over 166.25? Can we rotate back to the top end of the range? That is Watson. Let's take a look now at GDDY, GoDaddy. Thought I'd never hear this name again after their sort of cringy commercials, can we say, back in the day. But regardless, look at this thing. Bull flag here up near these highs. Look at the great move. It's technically a bullish engulfer. You know, it sweeps underneath the previous day's low, closes over the previous day's high. Bull flag. This thing has been a nonstop move in the upward direction. Look at this. Off of the lows back here. Just unbelievable on the weekly time frame chart. So here it is on the hourly. Look below and fail on the range. If we can consolidate in the range or break out over 140.85, looking to align with longs out of GoDaddy. Let's move along to MS. Morgan Stanley is up next, sort of a compatriot, if you will, to JP Morgan. I wonder if they get along there. Let's go ahead and take a look at, let's go daily chart here, not weekly. There we have it. There's the 3 back-to-back hammers that we were looking for. So beautiful. Again, let's even go to the hourly chart. And if you do this, notice that we took out the low of this hammer on Friday. It's very, very nuanced, but it is there. You can hover your cursors on your own platform. But if this breakout continues, like there was a failure from the sellers underneath the lows, looking for the gap to close, and at least beyond that, a retest of 99.75. So perhaps a cheaper price point to a similar continuation move as JP Morgan off of the pullback. This one is looking to get in gear and play nicely with the financial space if it moves in the upward direction. Last but not least is MRNA, as we call her. What's going on with the daily time frame chart? Look at the astounding relative weakness. So flipping the script. Instead of relative strength, talking about relative weakness, look at the extremely weak close at the bottom of this move. This is concerning, especially if you take note of the weekly time frame chart. This was breaking out of a base here. You could call this inverted head and shoulders. You could call it whatever you'd like, but really not getting much love through the weekly 200 SMA. So if we go back down to a daily time frame chart, the exploit here is that anybody like breakout buyers, look at the volume, right? You know they're there. Any breakout buyers who are going to close out underneath that low, close out underneath the inflection point here at 140.50, then guess what? We're looking for a move here under 140.50, 130 trades. That's, let's just round there and call it a 10-point move. Certainly worth watching for. I think that these bars can sort of distort our perception of the move recently, but this is still a very large range to be trading for, the retest of this breakout point at 129. That's ultimately what I've got for you in today's episode of the Weekly Watch List. If you enjoyed the video or learned anything new, let me know down below in the comments section or by giving the video a very simple thumbs up. We will be live at 8 o'clock every single day of the trading week for our typical pre-market prep. We hope to see you there in the office. And with that said, I wish you a green trading week.